Happy Monday, everybody. I hope you had a great weekend. We did seem to have some bouts of spring here in Chicago, but then came along with Old Man Winter right behind it. So, never a dull moment in the weather department here either. So, today is March 31st, 2025, and this is the official last day of Q1 and your Monday market update. It seemed like the quarter end excitement played out last week, but today we'll actually close it out for real. So, let's talk about last week and let's preview the week ahead. The final full week of March was marked by significant volatility driven by escalating trade tensions, concerning inflation data, and declining consumer sentiment. On Monday, markets began the week on a positive note. Investor optimism was fueled by reports suggesting that the White House might adopt a more targeted approach to the tariffs scheduled for implementation on April 2nd. Despite mixed economic data, including a robust services PMI and a contracting manufacturers PMI, the focus remained on potential easing of trade tensions. The Dow was up almost 1.5%, S&P gained 1.75%, and the Nasdaq Composite up almost 2%. The market continued its upward trajectory on Tuesday. A notable decline in the Consumer Confidence Index, which dropped 7 points to its lowest level in 2 years, did raise concerns. However, investor sentiment was bolstered by President Trump's comments indicating progress in trade discussions with Mexico and Canada, as well as a partial ceasefire in Ukraine. The Dow was flat, the S&P 500 was up less than 0.25%, and the Nasdaq was down just under 0.25%. Midweek Wednesday, and the markets faced the music and the downturn. The decline was attributed to new trade developments, including discussions of reciprocal tariffs with China and ambiguity surrounding the administration's trade policies. More ambiguity. Additionally, durable goods orders showed an unexpected increase, though this was largely assumed to be demand being pulled forward in anticipation of tariffs rather than organic growth. Investor sentiment mirrored levels seen during the fall of 2022, typically associated with deep market corrections. The Dow was down 1/3%, S&P was down 1.25%, and the Nasdaq was down 1.5%. As if everything was not shaken up enough, Tuesday brought more tariff announcements to heighten market volatility. The primary catalyst for the move was President Trump's announcement of a 25% tariff on all automobile imports. Negatively impacted automakers, of course, and intensified global growth concerns. Some relief was observed following statements from Mexican officials suggesting potential exemptions for U.S.-sourced parts, leading to a brief market rebound that was later overshadowed by fiscal health warnings from major rating organizations. The Dow was down 1/3%, S&P 500 declined 1/3% also, and the Nasdaq was down about 0.25%. The last Friday of the quarter brought sharp declines amid inflation and consumer sentiment worries. Markets sold off from the open, following through from Thursday's news, and between the PCE being hotter than expected, that was what we're waiting for all week, and the University of Michigan sentiment data, markets that were actually going into Friday, headed for a winning week, believe it or not, turned lower from the opening bell and did not really look back. Overall, we've come to understand, once again, the magic word here, uncertainty, and the markets do not like that. Between new eco data and Fed head talk that makes you question the next Fed rate cut, to the trade deadlines coming up this week, April 2nd. Add in the unknown effects of tariffs, and we have a recipe that we have gone somewhat risk off. Let's wrap the day, and then I'll give you some perspective. Then we'll go into this week. On Friday, again, markets experienced significant losses. The Dow Jones Industrial Average dropped 1.7%. The S&P down 2%, and the Nasdaq was down 2.75%. That brought the week from the green into the red. For the week, the Dow Jones was down 1%, the S&P down 1.5%, and the Nasdaq was down 2.5%. These declines seem to reflect heightened investor anxiety over trade policies, inflation pressures, and the potential for economic slowdown. Before we go off and we bury our heads, as I've been telling you, this is normal. Never feels good. And if you asked me a few weeks ago, I told you that it would feel like you were getting your face ripped off. And it does. Recency bias. Yes, as we discuss all the time, when markets go up for 2 straight 20 plus years, we think that any red ink is the beginning of the end. Year to date, the Dow is down 2.5%. The S&P was down a bit over 5%. The Nasdaq, it's down the worst, a bit over 10%. Why does it feel so bad? We're going into the last day of the month. What an ugly month it has been. The Dow was down 5.25% for the month. S&P down 6.33% for the month, and the Nasdaq was down over 8% just for the month. Now, I'm not suggesting we should like this, but it is normal, and I have to admit, based on where valuations have been, this is a good thing. Take a breather. It also allows us to better evaluate any necessary actions on your investment plan. Let's look into this week ahead. First, the first week of the month is always jobs week, so the big one comes Friday, and that is non-farm payrolls, but we'll get JOLTS, ADP, and the high-frequency jobless claims and continuing claims. during the week. Other eco data to watch, since the magic word I mentioned earlier was uncertainty. I'm not sure what this word trade does, but the trade numbers will be out Thursday, and that may or may not get some coverage. But Wednesday is Liberation Day for President Trump, so this will take all of the air out of the room. Just not to miss anything, we'll get some PMI reports, manufacturing, and even some factory orders. And all of this, while it will get drowned out by the noise, is an important signal. This will outline the growth we're all watching and worried about. And I thought, and though I don't think the Fed head bingo game will get much news, we will get a full load. Barkin, Kugler, Jefferson, Cook, Barr, Waller, and we'll even hear from Powell. Not only are they probably going to be overshadowed by the president, they've all been pretty clear that many of them feel that they are in a good position to wait and see. And if all that was not enough, earnings are only a few weeks away. The recent market volatility underscores the importance of maintaining a diversified portfolio, focusing on long-term investment strategies. While short-term fluctuations can be unsettling, remember, it is essential to remain committed to your financial goals so we can navigate these uncertain times effectively. Remember, these changes can and usually do breed opportunities. If you have any questions or want to discuss your investment strategy further, please feel free to reach out. For now, stay nimble, stay in touch, have a great week.